Okay.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the boys from Convoy. How you doing, Dustin and Jonathan? Wow, I merged that together.
We're good. We're good.
It's funny. Yeah.
You're just Justin from now on.
A lot.
Yeah.
Hey guys, I thought what we should do here is maybe just walk through a deal, just a fictitious deal. And what I want you two to do is ask me questions like I'm a client.
Okay.
And then I want you to play with the variables, because I don't think my audience knows all the variables that a sophisticated provider such as Convoy can tweak to get better rates, or really tell you, hey, this is an alligator, don't do this deal. Like we talked about somebody in video one, the rate got him because it went up, so don't do the deal. You give good coaching. But I just want to go through a fictitious deal. I want you to push, and then I want you to kind of say, hey, Mike, if you did this or you did that, rate's better. You game for something like that?
Let's do it.
All right. So I'm going to just do a fictitious deal. So get a notepad or whatever. So we're going to talk about a $700,000 purchase price.
Okay.
Yep.
That could be a fourplex, sixplex, whatever it is for this investor. We're going to say I'm willing to put 20% down, but
Okay.
maybe I should do more. I don't know. So tell me about that. Let's say income's, 5,500. So it's not a steal, but there should be some cash flow in that. What else do you want to know? Pretend like I'm a client. I just called you up, reached out via private client, and we're having our first call.
Okay. So $700,000 purchase price. You're putting 20% down. What is that? 560 purchase price.
Loan amount.
Sorry. The income that's the market rent, we'll call it 5,500. You said.
Well, actually, you know what? Let's just play this. Let's say actuals are 5,500, but let's say market 65. Right? I'm going to come tell you, hey, we got some value add. Rents are low. I'm going to sing that song right there on the fourplex. They're $250 low. So actuals are 55, but let's say market is 65. Let's just play with this.
That's a very real situation too.
Yeah.
Yeah.
That happens all the time because.
Of course, my audience is always looking for a deal. I like it.
Okay. So if on a purchase, what's nice is if the market rent's going to be 6,500, we will need to get this obviously validated by an appraiser. He'll come out and confirm that.
So that's very different than a traditional lender, right? Traditional lender is going to take the leases and go, okay, 55 is all I can give you credit for. We'll give you 70%. So non-QM or Convoy, you can, with third-party validation, use the 65?
Correct.
Wow. That's pretty cool. Okay.
Yeah, but here's the kicker. You need to have, there needs to be some sort of either intent that you are planning to either evict the current tenant, remodel, renovate, any sort of.
So I just can't pull it out of thin air?
Yeah.
Yeah.
The leases, a lot of times, people are holding on right now to a lot of old leases.
Correct.
Right. So it's like, if you have a month-to-month contract, our lenders will let us hey, sign an LOE stating that, letter of explanation stating that you intend to move them out. It's a month-to-month contract, so we know that there's not a long-term extension signed, and then they'll kind of consider and allow us to use market rents instead of the actual rents to qualify.
So tell me about an LOE again. This is the first time I've heard that acronym. My audience might have missed it. What's an LOE?
Yeah, LOE is letter of explanation. So that's just
the plan.
It's just like an underwriter condition, would send out a DocuSign, just letter of explanation for anything, right? Question that they have. Do you intend on, replacing the current tenants? Yes, we do, and sent stuff like that. Yeah. Well,
this is why we're doing a real deal. Just walk through together, see how it goes. So again, we're talking about, in this instance, the tenants have month-to-month leases, which gives you, the tenant, you, the landlord, or the new buyer, the ability to raise rents, remodel. But again, if you get the leases and they're on a 2-year contract and they're 2 months in, you're like, nah.
Yeah.
No, I like it. Okay. What's next?
So if I'm going to crunch the numbers, then if you're telling me it's 55, I want to use the worst case scenario, because we know the current rent right now, worst case, we're going to get 5,500.
Okay.
Penciling out right now on a 560 loan amount, we have two options. If we go with I'm going to hypothetically, let's just say taxes and insurance are $1,000 a month. That's probably pretty high, but we'll use that depending on where you're at, right? Sure. So at, let's say 6.5% on a 30-year fix, we're at new monthly payment of $45.39.
Mm,
Okay.
mhm.
So what we'll take is we'll take 5,500, which is the rent,
Yep.
and we'll divide it by 45.39.
Mhm.
We're at a 1.22 debt coverage ratio. Okay, which is good. It's above 1.
Okay.
But the higher the debt coverage ratio, the better the rate we can get you. So
Okay.
what I would show you is one that payment of 4,500 that we just went over, that was a 30-year fix, right? Principal and interest, traditional loan.
Mhm.
We can go to a 30-year interest only or a 40-year interest only, but I'll keep it the same. So it's 30-year interest only, okay?
Okay.
And that payment then would be at 4,033, okay?
Ah,
When you
okay.
include taxes and insurance.
Okay.
So now what we'll do is we'll have a debt coverage ratio that's at 1.36, okay?
Got it.
Because we're above 1.25, now I can get the rate down to, let's say, 6.125 instead of 6.5.
Wow.
And now we're talking then, another savings of about another $150.
So again, so this is what I want people to hear. And again, we're just doing this live, so I'm glad we're catching some of these. So a debt coverage ratio of 1.25 or above provides a better rate, period.
Correct.
And it's a scale,
Of
1,
course.
1.1, 1.25, 1.5. It really hurts if we get something below 1. Now, the audience, for not everybody's like you or has the mentality of it has to be over 1. We get those, of course, because they have
Mhm.
bigger fix and flip plans, we'll call it.
Mhm.
Even if a debt covers at 0.5 and you're planning to exit in a year, we can still do it, but the rate's going to be a lot higher.
Yeah, you're not a one rental at a time fan if you're doing that.
Yeah.
I'm just saying. I'm just saying.
But we find a lot of those properties like in LA,
Sure.
where it's the future, or in California in general, it's like the future rents. I think we kind of touched on it in a few videos before, but it's like if there is the perspective to be able to increase rents to a point where they're going to get it back,
Mhm.
then it's still a good deal, I think, once we get out of moratorium, because
Sure.
California is very strict on that, obviously, as you know, and we've all been dealing with. So
Yeah.
once we're out of that, I feel like people will start cash flowing better. But as of right now, rents are
Yeah.
low. So
Yeah.
Those are
So
the
that's cool. We found a way we can save, I think it was 3/8 of a point in this example. It's not a quote for business or anything. It's just an example for education.
Correct.
Let me ask you this. In this example, I told you I wanted to put 20% down, but let's say I came to you and says I could put 20 or 25% down. Does that 5% buy me anything at all? Or is it just a waste of money?
No, that 5% actually is almost it almost gets you like halfway of that cash flow number that Dustin was talking about, a decreasing rate. Because you're lowering the loan amount by 5%, you're increasing. So the lenders, obviously, from a risk perspective, right? If you're putting 80% leverage or 75% leverage, which
Right.
means 20% down or 25% down, they're going to give you a little more favorable terms for the 25% down.
Okay.
And the loan amount's lower. So that means the cash flow number wise, right? The number that Dustin was, I almost called him Justin, was putting in, now we're looking at, let me see really quick, at the same, now it's an extra $200 lower on the monthly payment. So now your debt covering, instead of what it was
1.22.
You said 1.36 it was before, right?
Oh, that was interest only. Yeah.
Yeah,
That was the
interest only.
But
So
now he can get a 30-year fix.
yeah, now you can even get a
be
30.
above 1.25.
Yeah.
Yeah. So I just want to, because we went through 2 scenarios, right? The first time was a fully burdened. We were at 1.22. Then we went IO only. We went to 1.36. If we go back to the 30-year fully amortized, we are also above 1.25 because of the extra 5%.
Correct.
Exactly.
Correct. And then that obviously offsets and allows you to get, access a lower rate, without as many points.
How about the buyer's credit? Does that matter to your, does that, like, if I have a 780 versus 680, does that matter at all?
Yeah, because we really try to, and we've been, trying to be as vocal as possible to everybody that could be a client or the community or the mortgage industry. We're not subprime. We don't care, in terms of, or we do care, pardon me, about somebody's ability to repay. Do they have the history of making payments on their mortgages on time? Because that obviously goes a long way. And, this is a completely different type of loan product that unfortunately some people still view non-QM as like a subprime loan.
No, not
It's
at all.
that at all.
Not at all. Not at all. What else, just as we're talking about a real deal, that I could do to help get better rates that you could think of?
I think also having a lot of clients, will have maybe some assets and extra money on the side that allows the lender to feel a little more comfortable about lending.
So reserves.
Yeah, reserves, exactly. If you usually have like 12 months of reserves, it is a little better than just 6 months of reserves.
All right.
The minimum required though for most of our lenders, I think, is 6 months.
Okay.
So, and that's just on the subject property. So a lot
Correct.
of people are, well, I don't have, $100,000. You don't need $100,000.
It's just for that.
Correct.
Okay. I
Yeah.
like it.
And it's whatever the payment is. So if we go interest only payment plus taxes and insurance, or principal and interest, tax and insurance, whichever one you guys decide on picking on is the 6 months, multiply that by 6, and that's going to be the reserves you need. So yeah, that's how it works. I think that also helps. But in terms of rate, like for non-QM world, there's a floor, right? There's a floor rate. Let's say it's 6 1/4, 6 1/8, whatever the rate is.
Yep.
Depending on the lender,
Sure.
that's as low as you can go.
Right.
Right. So it's not like a conventional loan where you can pay even more points to get below there. You can pay like 30 grand to get below to, 4% or something. It doesn't work like that. So
Yeah, you have a
once they
floor rate.
Yeah, once they have a floor, that floor is the floor. Can't go any lower than that. And I mean, a lot of times it's just about the cost to get down to that floor.
Yeah. I like
So
it.
yeah, that's what it is.
So again, real estate investors, go ahead, Dustin.
Obviously too.
Oh, yes.
That's a big thing.
Yeah.
I missed it. What'd you say? Sorry.
Investor experience, if
Oh,
you're
yes.
an investor compared to somebody that's got even just 1 or 4 or 5, that definitely helps too.
That's awesome. Again, non-QM world. If you're new to the non-QM world, reach out to these guys, figure out what's going on, run a base deal structure by them. They're very quick, very helpful. How do you want them to do that?
Please email privateclient@convoyhomeloans.com.
Yep. Let them know you came from one rental at a time. Jonathan or Dustin or Justin has promised to take care of you guys. Thanks, man.
Absolutely.
All right.
Thank you.
Mhm.